Now let's move over to American Airlines. All right, so this one, it is, whoo boy. Now, you haven't taken a look at these fundamentals yet. I just did. It's gonna be an interesting one for you, good sir, when you actually input those, when you actually input all of those assumptions, because yeah, is it a
crapshoot interesting, or is it one of those it's actually interesting? Or am I gonna find out?
Yeah, you're gonna find out. You're gonna find out. You're gonna find out. All right. So let me input all of these over here when it comes to American Airlines.
And the question I have is Dom Miles still on? Are you still in the chat? Throw something in the chat if you're still here, because I know you wanted to hear our thoughts on American Airlines.
Better be. So here we go, man. American Airlines. Oh dear lord. Oh dear lord, man. I just saw this and I'm floored by this. All right. So here we go, guys. American Airlines. Now, right off the bat, COVID hit airlines and cruises hard, right? Hard, to the point that they have not recovered. I haven't covered a single airline for, I don't think I've ever covered a single airline actually here on the channel. Maybe I have, but I don't really remember.
I don't think you have.
What was that?
I don't think you have. I can't remember.
Yeah, I don't remember either.
Okay, first time for anything.
I think the closest I got to an airline was Boeing. I think that's the closest I got to it.
Okay, that don't count.
I know it doesn't count. I'm just saying that's the closest I've ever gotten to it. But I know for a fact I never covered a single earnings of theirs. So this is the first time right here, guys. And let's get started with the analysis on American Airlines. So let's come over here. And we got American Airlines non-GAAP EPS of $1.92. So right then and there, it's in the positive, right? It's in the positive. Beats by 33 cents. A revenue of $14.1 billion. Beats by $370 million. Okay. All right. That's looking all right so far, right? That's looking good so far?
Yep.
Great. Let's come over here. This gives us a much better representation. We can see that again, $1.92 for the EPS normalized actual, beats by 33. EPS gap, all in the positive, $1.88, beats by 35. Great. Revenue, $14.06 billion. That is the same as this, right? Yeah, okay, so they're rounding up. Revenue of $14.06 billion, beats by $323.36 million. Great, everything is rosy. Alrighty. Let's jump into their earnings, shall we? Let's come over here. Again, this will be linked in the description below, guys, if you would like to follow along. So, we got record... Let me actually zoom in a little bit. Okay, so we got American Airlines record quarterly revenue of $14.1 billion, a 4.7 increase year over year. All right, that's looking good. Second quarter net income of $1.3 billion or $1.88 per diluted share, excluding, this is the one for today, right? Yeah. Okay, just making sure. Excluding net special items, second quarter net income of $1.4 billion or $1.92 per diluted share, generated operating cash flow of $1.8 billion and free cash flow. You know, that's my favorite thing, man. That's free cash flow. Cash flow is king. Cash flow is king. Free cash flow of $1.2 billion in the second quarter. Ended the quarter with $14.9 billion of total available liquidity. That's good. All right. Raising full-year adjusted EPS guidance between $3 and $3.75. So they also raised that. We didn't take a look at the Capital One guidance, though. I don't even think they had any. I think
they were very vague.
Yeah, I mean, guys, this is why we put everything in the description, because you guys should read it for yourselves as well. If we missed something, please leave it in the comment section, leave it in the chat. You know, we're just two people, right? We can't. There's no way that we could be that perfect, right? So obviously we'll miss some stuff, and if you guys know something that we don't, please tell us, right? Please tell us. All right. So with all of that, I don't know if you know anything about this. Credit rating upgraded 2 notches to B+ by Fitch. Do you know anything about that?
So it's basically because they're a debt churning machine. So they basically, or do they have bonds on themselves? Because they could have corporate bonds.
They could have corporate bonds. All right, so here we got the comment from the CEO. Quote, It was another fantastic quarter. Love that word. Driven by the hard work of our team to deliver a reliable operation for our customers and the continued strong demand for our product, said American CEO Robert Isom. Quote, our operation is performing at historical strong levels, and we have worked to refresh our fleet and build a comprehensive global network, all of which helped to produce record revenues in the second quarter. We will build on the momentum for the rest of the year and continue to prioritize reliability, profitability, accountability, and strengthening our balance sheet. All right, so here's a question I probably should have started this segment with. Hey, Mike, United, American Airlines, or what's the other one?
Delta.
If
I have to pick which one I want to fly, or which one's the one I'm going to pick?
Which one do you like to fly?
Delta.
Yeah, I'm a Delta guy too. I'm a Delta guy too. I never flown American, but I hear it's a nightmare.
They're not reliable.
Okay.
United and American Airlines are about the same, but American Airlines has a little more issues.
Yeah, when I went to Florida this year, we rode on Delta, and not my wife obviously, but then my girlfriend, she was just like, oh, I don't know about Delta, and I'm just like, you do realize that they give free TV, right? Even if you're in coach. so like it was just like, really? I'm just like, yeah. So we watched the movie there, even though we weren't on like first class or business class. So that was interesting. All right, so let's take a look at this. We got running on reliable operations. The American Airlines team delivered a strong operational performance. Do they have any numbers? That's what I want to take a look at. Of course, they have the numbers somewhere else. All right, but they do have the guidance and investors update. Based on demands and trends and the current fuel price to... Ooh, weren't you talking about that?
Yep.
Okay. You want to get to that in your segment or right after this earnings report?
Let's get into my segment. We'll save it for them.
All right, you'll save it for that. Based on the demands and trends and the current fuel price forecast and excluding the impact of special items, the company expects its third quarter 2023 adjusted earnings per diluted share to be between 85 cents and 95 cents. American now expects its full year 2023 adjusted earnings to be between $3 and $3.75. The company's forecast includes the estimated impact of anticipated new labor agreements. That's it. Wow. Okay. Let's take a look at these numbers, though. Let's actually take a look at these numbers and let's see what we got. Let me actually put it in the chat for everybody, if everybody would like to see. Let's go over here. So that is the financial statement when it comes to American Airlines. Okay. Total. Do we have total revenue? We got total operating revenue. Again, I've never done any airlines, so I have no idea how any of these numbers actually
Total
look
operation
like.
expenses?
What was that?
Total operation expenses?
No. That's expenses. I want revenue. So I'm assuming it's this, right? I'm assuming it's this. So the total operating revenues. Again, I don't do airlines. Most companies just say total revenues and be done with it. But they have a bunch of passenger, cargo, other. So when it comes to the total operating revenue, 3 months ended 2022, 13.4. That was an increase, 14.05 billion dollars, increase of 4.7%. 6 month ended, that is an increase of 17.6%. All right, looking now into the net income, guys. Why does that say loss? Seriously, why does the net income there say loss? It was it gained, right? 476 million to 1.34 billion dollars. I don't know why it says loss. And then even on the 6 month ended, we got 1.159 to that's still an increase. That's an increase, and then to today of 1.35 billion dollars. So that's an increase right there as well. I don't know why they mentioned the loss right there. That's kind of weird. All right.
Or it can mean parentheses mean loss.
Oh, you're right.
Yeah.
Yeah, you're right. If it's in the parentheses, it'll be a negative, obviously. All right. That makes sorry. You're absolutely correct. Is there anything else here? I mean, this is just a lot of jargon that we got over here. We got passenger revenue. Again, I've never really analyzed any of this. It's the first time I'm looking at this. We can see, when it comes to domestic revenue from passenger miles, that was an increase of 0.7%, 39.45 39.48 to 39.75 or 39.76. Is this in millions?
I would
Yeah,
like
this is
to
billions.
go. I would
What?
like to go to see its fuel consumption. If we
Okay,
go
so
up,
do you know where that is?
second page.
Second page.
Yeah, it was under
Right there.
right there. Fuel consumed gallons in millions, so they're consuming more fuel. So they're having more flights, so more demand. So it's interesting, but also fuel is at a cheaper price compared to a year ago, so they should have higher revenue.
Got you. Which they do though. They do. But is it relative though? I mean, it's up by $1 billion. Well, less than that, but $600 million, right? So, yeah. All right. Well, is the guidance here? I wonder, because I want to take a look at that guidance because I want to see how much it gained. You get me? Guidance. No, it's not here. Huh. I know we had a guidance increase, but I don't. I want to see by how much it was by, but I don't necessarily know where it is. If you know where it is, please let me know, Mike.
I don't see it.
Yeah, I don't see it either. Do we have? I just realized, do we have the free cash flow? But I mean, we do. Let's take a look at the free cash flow. Let's take a look at this. Free. Okay, free cash flow. Okay. But okay, I love how they give me right here the free cash flow, but it's in the 6 month ended and they don't show me the previous one. Okay, let's see if we can find. Is this for? It's still 2023. All right. So, unfortunately, they do not give me the free cash flow for 2022. I kind of wanted to see that, but we'll see it in the discounted free cash flow part. So that's not really much of an issue. Free cash flow on the 6 month ended, that is $4.26 billion. So, again, I have no reference for this. I think we should just get onto the discounted free cash flow, which we can use discounted free cash flow for AAL. So we got the ticker for, as I just said, AAL, market cap of 11.4 billion, a PE of 6.6, and a current share price of $17.44. Taking a look at this graph, guys, this thing today fell 6.25%. Post market already down 0.11%. Absolutely nasty. Now in the 1 year, this is up 14.66. Year to date, it's up 37%. Here's the thing, though. If we take a look at this in the 5 year, have you taken a look at it yet or no?
Yeah, it's absolute insanity.
All right, ready? 3, 2, 1. It's actually not as bad as I would think. It's actually not as bad.
Go to max. Go to max. It'll be.
Oh, go to max. Okay, go to max.
Yeah.
Wow, that's a lot of. Is it the company handle?
Is it 07? Then you got the 2016 rut, and then you got the 2019 into 22. So it's
2020 into 2020. Yeah, this thing has just gone nowhere. Seriously, this thing has literally gone nowhere. We went in 2000, as far as I could go. I don't know if you go further back. October 3rd, 2005, $22, and let's move it. $22.27, 15 cents. All right, today. $17. We're actually down, guys. That's insane, man. Talk about a lost
going sideways for a while.
A lost 2 decades?
Yeah.
Right? Lost 2 decades. Dear Lord, that's insane. We're almost to 2 decades. Oh my God. All right. So, yeah, man. Talk about a company that has just gone absolutely nowhere. Now, coming back into this, they don't pay out the dividend. Here's the thing, though. They used to pay out a dividend. And I'll give you you want to guess when they cut it?
Let's see. COVID, probably.
COVID. So if we come over here, we can see that they did not pay out a dividend, but we do have a dividend history. If we take a look at this, yeah, look at that. It wasn't a lot, though. It was only 10 cents. And they cut it right before the pandemic went on February 3rd, 2020. Yeah. And if we take a look at this on the max, honestly, they had a dividend, but it's been 10 cents this whole entire time.
It was a dividend to say you have a dividend.
Pretty much. Yeah, it was a dividend to say you have a dividend, but aside from that, there's a reason why one of the first airlines I invested into was Delta. It wasn't American Airlines, it wasn't United, it was Delta. So, yeah, that's probably the reason why. But honestly, guys, I think every single airline cut its dividend. They have not recovered that dividend ever since, so kind of understandable. Coming back into this, well, seeing that they don't pay the dividend, this free cash was going straight into themselves. But we got a few problems here. we got a few problems here. So obviously, what was that?
All right, let's see.
Well, you're looking at it right now. Look at that 5-year average free cash flow.
Oh, sorry. I thought you were going to the graphs.
Not yet.
Wow, just ouch.
It is increasing, and obviously we just saw that the free cash flow isn't the positive. But again, if we come back over here, the free cash flow isn't the positive for the 6-month ended, guys, for half the year. Doesn't necessarily mean we'll end in the positive, all right? So just keep that in mind. So still though, the 5-year average negative $2 billion. Last year's free cash flow negative 733. It's heading in the right direction, but let's actually see how these graphs actually look like. Mike, are you ready?
Yep.
Is your body ready?
Yeah.
All right. You better be sitting down because you'll stand right back up when you see this. All right, guys. Here's the fundamentals.
Just no. Just like no.
Give them a break. They went through COVID.
Okay, COVID. Okay.
Give them a break. They went through COVID. Come on.
Okay, fair enough.
We got the net income 5 years ago of $1.4 billion to a year ago of $127 billion. Million with an M, by the way. So that went from a B to an M. Decrease of 91%. I don't see any major outliers here, right?
Just the center of the graph.
Just the center of the graph. Just the middle finger going down, right? Perfectly explainable, though, COVID. You understand, right? It's perfectly understandable. So I look at this and I'm like, 5 years ago to 4 years ago increasing, COVID happened, and look at that jump. At least they've been recovering.
So the thing is, like, I'll give you my grade and then I'll explain like why.
Give me your grade.
I'm saying a 50 for one reason.
Okay.
People that are, you haven't fully fleshed out the recession. You haven't.
It's true.
Travel is basically a luxury item. So people, as inflation, you haven't got that under control. The Fed is tightening. So you have all these financial conditions that are basically like creating a storm for this sector as a whole, not just this company, a sector as a whole. And now you have student loan repayments, which are going to suck any money out of the youth to go on travel or anything. And like, when I say youth, people in their 20s and 30s, because they're paying this debt off for forever. So it's going to be, they haven't recovered from COVID. So it's going to be still more difficult. They're going to be tracking into a difficult area. I'm not trying to beat them up, but it's going to be difficult for them.
All right. And you said 50.
Yep.
I actually agree with that statement. I actually fully agree with everything you just said there because, I mean, there really isn't anything else for me to say. So, free cash flow time. Are you ready for this?
It's probably the same.
Or is it? It's probably the same. Yikes. So, let's actually take a look at this further because remember what free cash flow is? Do you remember the formula for free cash flow?
Nope.
Cash from operations less your capital expenditures. So if we come over here, we can see that the cash from operations is 3.5, 3.8, COVID, right? Look at that, look at that massive drop. That's understandable. And then 704 to 2.1. That's crazy. So that's a massive jump right there in the cash from operations. But even 5 to 4 years ago, it is still a pretty modestly increase, right? $300 million is modest. The problem is this. The problem is the capital expenditures. 3.75 to 4.3, right? That's $1 billion in increase of capital expenditures when the cash from operations only went up by 300 million. You feel?
Yeah.
You feel?
But they're an airline. They run on debt.
That's true.
That's literally,
which
is not a good statement in the current environment that we're in.
Right. That's absolutely true, though. But I'm just letting you know that this was the reason why. It's mainly their capital expenditures.
Gotcha.
Okay, it's not cash from operations coming down. Obviously, it did, but it came down for a very good reason. So keep that in mind. I just love throwing just wrenches into all of these graphs because it's difficult, man. It's difficult to invest financially. Go on.
I'm gonna lean towards like a slightly worse grade because it's not necessarily COVID, and it's not necessarily like the whole operation. Like it's a debt churning machine, right? So if you identify as a debt churning machine because they're just constantly going through planes, because that's how airlines work. It's like, like it's like a rental service, right? So they buy planes, they use them, and then they sell them. And
Is
they
that
keep,
true? I don't know. I don't know.
they sell them to like smaller airlines. So like they'll buy it from Boeing or Airbus. They'll use it for a bunch of time, like smaller aircraft, not like 747s or anything like that.
Right.
And then they'll sell it to like regional airlines or something like that.
Or even privates. Or even private.
Yeah, well, it depends on the aircraft, right? So they're debt churning machines, and they use debt to keep their business going. In an environment that they're going into, on top of what higher oil prices, the Fed basically trying to crush the economy, it's not a good outlook. Right. That's why I'm saying I'm not going to be super mean to them. I'm going to say like 40, because the 50 would be appropriate for it because it's like, okay, COVID, same analysis like before. But the Fed is trying to absolutely destroy the economy, and you're literally number one on their hit list.
Yeah,
because they want travel and leisure to go to zero.
You're up there. Yep, absolutely, absolutely. And again, 5 years ago, guys, negative $212 million to 1 year ago of negative $733 million. That is a drop. Look at that. That is a drop of 246%. Insane. And we already saw the average, negative 1.9, let's just say negative $2 billion, right? So I agree with that statement. I do. It's just the cash from operations, man. It's like, it's not a decrease in cash from operations, except for obviously COVID in the following year. But it's mainly the capital expenditures. But you're right on that, though, right? You're right on that, is that they are heavily on debt. Most of these companies, well, I wouldn't say, let me roll that back. I have not taken a look at United Airlines or Delta, okay? So
but
for all we know, it could be different. Huh?
But you can make assumptions that this industry runs on debt.
I'll make an assumption on that after I see another one.
Okay, fair
Okay,
enough.
I'll make an assumption after I see another one, but you know, I could see it. I could see it. So I agree with the 40%. All right, looking at the revenue. So this is interesting, isn't it? 5 years ago,
actually good.
Yeah, great. I'm so glad we agree on that one. 5 years ago, 44.5 billion to 1 year ago of $49 billion, increase of 10%. Thoughts?
I wasn't expecting that. I was expecting a turd graph, but COVID, this, that, better recovering after COVID. So yeah, that's like 90.
If you take if you take the 3 and 2 year ago values as outliers, this is essentially a straight line going up. Well, I'm sorry. Not, you know what I mean. The trend line is slightly inclined up.
A positive slope. Positive slope trend line.
Right, positive slope trend line. So what'd you say, 95?
Yeah.
Nah, I agree with that. Well, not 59, not 50, 95. 95. By the way, shout out to the 8 of you watching on Rumble. Guys, thank you so much again. So terribly sorry for starting the stream late. It was on me, not Mike. We can blame him some other time. And to the 7 of you mad lads also watching on YouTube, thank you so much, guys. Please make sure to hit that like, as well as YouTube and Rumble. It really does help here. If you like this type of content, we put out videos daily, right? We put out videos daily.
Unless we're live streaming.
Unless we're live streaming, because then we just put the live stream as the videos, and I just segment them. I put the timestamps in that video just so that way you guys can watch it. So, I'm not going to do the double job. It's just stupid. But he does technical analysis. I do fundamental analysis. Hopefully, the more you guys subscribe, the more you guys like, the more we grow the overall business, I guess you could say. We can incorporate more people. I would love to bring in somebody who does... you know who I'm talking about, right? Somebody who does,
Quantitative.
Qualitative analysis, as well as somebody who does precious metals like gold, silver. I know you do a little bit about that, but let's face it, you're more of a TA guy.
Not to the level of people that are into the industry.
Rich, we're talking about you. Ricardo, we're talking about you. So, the more guys that you like, subscribe. Again, all of that is free. The more you do that, if you like this type of content, the more we'll grow. The goal is to eventually have like a Tim Pool kind of style live podcast in real life, IRL. We're not going to take his name, though. We're going to come up with something else. But that's essentially the goal. So, again, if you guys would like to help us achieve that goal, please like, subscribe, comment, and of course, share. It really does help. All right, so let's continue with this. Take a look at this assets minus the liabilities. Oh, dear Lord. Oh, dear Lord. So it's in the negatives by a lot. 2 years ago to today, it's going up, but man, this is just bad. I don't even know. Good luck giving a number for this one. Average total assets, it is $64 billion. Average liabilities, it is $69 billion. Doing the difference, we get negative $5.2 billion. You called it, though. You called it. Massive amount of debt. So what would you give this as a grade, good sir?
Knowing massive amount of debt, I want to say 0, just because you're literally giving the bullet to your executioner and saying keep raising rates, and yeah, that bullet's not gonna go off.
But I have to fight though. I have to fight you on that though.
Okay, what would you give it?
No, I'm not. No. I'm just gonna fight you on that statement because look at this. Even 5 years ago, negative 169 million. 4 years ago, negative 118. COVID hit. Really can't blame them for this.
I'm not blaming them for that.
They brought it up, though.
Dead cat bounce?
That's one way to say it. That's one way to say it. All right. So what would you give this as a grade, then?
I'm still saying I'll be nice. I'll say 10.
10.
I'm not going higher.
All right. I would not want you to go higher. But I think 10 is appropriate. See, again, they did increase it even from 1 year ago to today. But again, we have no idea where this is going. It's really, really bad. Okay. What was that?
It's still a turd.
Well, let's see about this. Let's see about this.
All right.
Cash flow minus the liabilities. Take the cash flow, subtract the liabilities. What we're hoping here is this thing to get closer and closer to 0. What we have is actually not that bad of a graph. Tell me what you think.
It's not as bad as the other graph just because it's trying to go back to the mean that it was before the 4 and 5 year. I don't like the graph as a whole, but it's one of those, they're making progress, so I have to give it 50% because it's like, okay, you're making progress, you're doing better, now prove to me.
Well, here's also too, man. 1 year ago, they did a negative 71.25 billion. It's lower than the average of negative 68.8 billion. But here's my rebuttal to what you just said. Look at that buyback from, I wouldn't say buyback. Look at that reduction in, I guess, debt. It's not reduction in debt. It's more of a cash flow minus the liabilities. 5 years ago, negative 60.9 billion. Then negative 60.66 billion. COVID hit. Understandable. You can pretty much ignore that. But even then, look at that. Negative 77.55 to negative 73.52 to negative 71.25.
And still, I just don't like the graph being so negative.
All right.
But because you're exposing yourself to the whole Federal Reserve.
All right. That's perfectly fine. So what would you give this as a grade then?
We'll do 55.
55? All right, 55 it is. And by the way, the carnage continues with the shares outstanding.
Oh, Lord.
5 years ago of 460.6 million shares to today of 652.8 million shares. Look at that increase, 41.73. With from the previous year to the current year is another increase of 0.34%. It's interesting and sad at the same time.
Yeah, it's like you can use like the jump theoretically like with COVID, right? But It's like, okay, so you screwed me with COVID, but okay, you're not doing anything to make it better.
Right. And on top of that, the share price does seem to be very, very small right now, at least based off of that PE. So why aren't they buying back shares, right? Why aren't they buying back shares? So that's something to note. The main one here is 3 years ago, COVID. As you said, we understand that, but why didn't you buy back at least 1 year ago? Why didn't you attempt to do that 1 year ago, right? So what would you give this as a grade?
10. Just because they're not justifying anything that's helping the investor.
What'd you say?
10.
Oh, I heard N. I'm like, what? What is it? What is it? Okay. 10%. And lastly, cash and equivalents, we got $452 million with an average of $327.5 million. All right. Ready for this overall grade?
Yep.
47. It's below 50. The main problem though is the debt, man. Is that Is it not the
They're
cash flow?
debt churning machines.
It's the
They're-
assets
it's
minus the
what-
liabilities. Yeah, and the shares outstanding. That's the main problem here. Because even the free cash flow, it's like 40%. It's mainly because of COVID, right? It's mainly because of COVID. So they have a ton of debt, guys. They have a ton of debt. I mean, here's also something too, though. Airlines. How many do you know? How easy is it to make an airline? I would actually argue it's hard to make an airline.
It's pretty much impossible.
Right.
It's like a duopoly. It's not a duopoly, but it's technically like a triopoly.
It's more than that.
Because-
Think about Southwest. Think about Alaskan. Think about
But remember who their parent companies are?
No, I don't. What do you mean?
Airlines have alliances where they kind of like there's 3 alliances in the world, and basically it's a think of it like 3 cartels. So they don't compete with one another.
Sure, but don't say parent company though, because that makes it seem if they had a parent company, we couldn't invest in AAL, UAL and Delta. So just understand that it's not. They don't have a parent company. It's
not a parent company, but it's kind of it's like OPEC, right? So OPEC's not one. It's one group theoretically, but they all are independent.
It's an agreement.
They can all
It's an agreement, right? It's an agreement. No, I understand that. So I look at this, I'm just like, are they going to go under? Probably not, right? Probably not. Airlines are like oil manufacturing companies, right? Like upstream and downstream. We haven't had a lot of any oil refineries pop up in like 50 years or something crazy like that. So I kind of see them the same way. You get me? So,
yeah.
All right. Here's the thing, though. Massive drop during COVID. They have a ton of debt. What price do we pay for this company? Are you ready, Mike?
Yep.
All right. So let's jump into now the discounted free cash flow. Current share price of $17.44. Guys, take a look at this. Not adjusting for debt, $50. $50 for this company. Now adjusting for debt though,
on a debt machine,
on a debt basis, $3. 3 spackaroos. So what would you like to input first, the revenue or the shares outstanding?
Let's do shares outstanding.
All right. So do you remember what it was?
Nope.
All right.
Go
So
back to it.
let's bring that back. Yep. Let's bring that back. 41 in the 5-year. But remember that happened.
Flat right on the 0.34
Right.
for the year-over-year. Okay, so I got an easy number.
And they had 1 year of it coming down. I wish I knew what happened 6 years ago and 7 years ago, but I don't. So, know. All right. Go, good sir.
So buyback 2%.
Where?
For a high assumption.
For the high assumption, you think they're gonna buy back 2%? Okay.
Yep.
Remember, this is
they're gonna
cumulative. Remember, guys, this is cumulative in the next 5 years. So that's 2% total in the next 5 years. All right.
Yep. Buy back nothing
0
and issue 2.
and -2. All right, great. So let's come over here into Seeking Alpha, and we can see that the forward revenue, look at that. I think the reason why that's the case is because of the lack of demand, or sorry, not the lack of demand, the massive demand for travel. But you said it yourself. Economy isn't doing too hot right now.
And they're on the hit list.
Right? So 22.44, that's massive.
But the thing is, their revenue was increasing, so they're probably looking at historical ranges. So, like, let's say, let's do a high assumption like 30, 20, 10, like as your range. Just because, like, you can get a pretty good scattering of what could be your scenarios.
Hang on Rumble, we got Z Slaw. Hi guys, how can you help me to lose more money? If you would like to not lose any more money, here's a very, very simple thing to do. ETF invest. S&P 500, VOO. Pick your favorite ETF. Make sure that it is not based off of like REITs or the dividends that come from it,
Or a leveraged ETF.
Leverage ETF, or that the ETF doesn't have covered calls, like the dividends that you get from it isn't a covered call ETF. Just dollar cost average every single month. Put in as much as you want. Pick a number, put it in every single month, and if the market falls, you put in more. That's it. That's how you not lose money, by the way. So
spend the next 20 years doing that.
And spend the next 20 years doing that, pretty much. Then do not touch it. All right, do not touch it. Now, if you would like to do different strategies, like Mike does, he does technicals. I do fundamental analysis, but I mainly do a dividend perspective from a fundamental analysis. I have different ways of making money, right? I'm currently up $15,000 right now. My portfolio is crazy. So,
nice.
Losing money, man. It's sorry that you did. I haven't seen you around, so you're probably new here.
It's like paying tuition to the market. It's teaching you.
See it as like a lesson. We lost like $2,000 when we first started investing. Right now, I'm up 15,000. I don't know how much you're up, Mike, but we're doing good. We're doing good. So, if you don't want to do the hard work in the form of learning technicals or reading 10Ks, reading earnings reports, ETF, man. ETF, SPY, VOO, SCHD. Pick one. Pick whichever one you like. Not financial advice. And that's just that. So, all right, let's come back into this. Let's. What do you want to put for the revenue growth, sir?
I said 10, 20, 30.
10? That's a bro.
Hey, you want a wide assumption? I want a wide assumption.
All right. You want a wide assumption. All right, guys. With a required rate of return of 10%, we got $68.77 to $133.05. Let's look at this at a more realistic sense. Again, you did put 30%. That's huge. Okay. That's a 30% with 2% buyback. All right, so that's going to make things go up a lot. Adjusting for that, $23.48 to $86. Margin of safety of 5, 10, 15. $20 to $81.61. Current share price is 17. It's looking like a steal right now. I personally would wager more along this line over here. 10% revenue growth with a 2% issuing. So you can see 15% margin of safety. We're pretty much right there, right? We're pretty much right there. But then again, compare this to the grade. Guys, the grade, 47%. Fundamentals drive everything first, at least for me. If the fundamentals are great and the price is too expensive, I like the fundamentals. I'll buy it when the price falls. But if the fundamentals aren't there and the price is looking great, like we have as in this example, I don't even bother touching this unless the fundamentals get better. All right? So that's just kind of the way that I see it. What do you think about this?
You fundamentally can keep losing money for a long time.
Yeah.
That's how I would put it. Just because something is discounted, falls, let's say 90%, doesn't mean it has to recover.
Right. All right, and last thing when it comes to this, before we go, that's right, they don't pay the dividend. I was about to say let's go into the dividend, but no, they do not pay the dividend. So yeah. All right, guys, Mike, your turn, good sir. Tell us what the technicals say.
All right, so pretty much everyone that follows the channel knows my opinion of the 200 weekly moving average. You're above it, it's bullish. You're below it, it's bearish. You're basically hugging it right now. This is your retest. So American Airlines, basically the end of the week. So Friday, if you guys are watching this video on the clip or on the live stream tomorrow, you basically need to get above 1757. That's your goal. You need to get back above that level and hold it. And you don't want to close on a weekly basis below because it means it's bearish. Now, if you get it back above it, then you probably look at some more upside targets. The first target we just talked about is your $19-20, which is right up here. So it's not absolutely out of this world that it could reach that. And let's say this is an A to B pattern on the way up, targeting $20.42. So again, those lower assumption targets are definitely a possibility. And here it would be an interesting swing play with careful calculated risk. This wouldn't be necessarily for everyone with the faint of heart. So be cautious with that. Now, you did have this pretty much straight move into earnings. Everyone knows my opinion about companies that are running into earnings. It's a bad idea to play the bullish side on it just because your upside is limited unless they have an absolute massive beat. It's just E stands for exit before earnings, not necessarily go in on earnings. If we jump over to LuxAlgo, you can clearly see that we're targeting this price action zone here. So what it's telling me is we have a possibility of breaking that 200 weekly. The MACD is crossed and looking more weak right here. So if we pull this up real quick, you are crossed and heading down lower. So we definitely could see more potential to the downside. You have the impulse on the smart money flow that was buying American Airlines on this way up into earnings. So we have to see if that continues. So if American Airlines catches the bid and starts going up, gets above that 200 weekly, yeah, I think that could definitely continue as a run. I definitely think that it could pretty much keep running. It's not completely out of the question that $20-21 price target would be something that I actually be looking for. But however, if it closes below this 200 weekly moving average, is as simple as this: you get out, you wait, and you wait for the break back above it, and that's your risk to reward. That's the simplest way to invest on the technical side if you're looking for longer term investments. Like, hey, I'm above 200 weekly, I'm at a support, buy, and if I break the support, I sell. So that's just as simplistic as I can make it for the technical side. Risk to reward is not there for me just because I'm below an area that is crucial. I'm not really catching the bid. Some of these indicators are telling me that, hey, you may have more downside potential ahead. And it was a pretty nice earnings push down. It was a strong move with strong volume. So I do expect that to continue. And if I just jump over the weekly, like I always tell everyone, look at larger time frames. And MACD looks like it wants to start crawling back. We got the reversal sell signal on the weekly. So for me, similarly how we said with the fundamentals, wouldn't touch this company with 200-foot pole, and I'd be waiting for that weekly to show me a signal on reversal like we had back here, where had 1-2 weeks green, then had this nice move. So if you bought here, sold here, easy money. As same here, bought here, sold here. It's just pretty simple as that. Just these larger time frames are basically very easy to play out and see. So right now, American Airlines is an interesting opportunity, but I would not be buying it right now. I'd be waiting to see what it does.
All right. And that pretty much does it for American Airlines. Yeah, guys, airlines got hit. I would actually like to see the other airlines, not gonna lie, because I really would like to compare it. See if they do have that massive amount of debt as we saw. So